Welcome to the Wednesday edition of the Tech Stocks Daily Podcast. Today we're diving into a tech verse of drama, intrigue, and sky-high gains. First, we'll break down Rumble and Trump media's legal battle against censorship and international jurisdiction pressures that could redefine digital free speech. Then, we'll explore the highs and lows with Arista Networks, whose strong quarterly report was marred by cautious revenue projections. Finally, prepare to be astounded as we unpack AppLovin's incredible 4,700% stock rise, powered by its adtech innovations. Whether you're a tech-savvy investor or a curious observer, today's stories are sure to spark some conversation. Hey tech enthusiasts. Today, we're diving into a legal showdown grabbing headlines in the digital sphere. Rumble, the video sharing platform known for its dedication to free speech, is making waves alongside the Trump Media and Technology Group. Both companies have jointly filed a lawsuit in U.S. federal court, setting the stage for a compelling battle over censorship, jurisdiction, and the bedrock principle of free expression. The catalyst for this courtroom drama is Brazilian Supreme Court Justice Alexandre de Moraes. He's under the spotlight for allegedly overstepping his boundaries by ordering the suspension of accounts of a US-based Brazilian user on Rumble. The user, referred to in court documents as political dissident A, has been a thorn in Moraes' side due to his outspoken, politically charged content. This individual, a former priest and independent journalist, sought refuge in the US after being charged with various opinion-based crimes in Brazil. US authorities have already deemed these charges mere crimes of opinion and denied Brazil's extradition request. Despite this, Moraes isn't backing down. His latest demand? Rumble must censor this user or face grave consequences, such as daily fines and even a shutdown threat. Moraes' orders also call for the suspension of accounts, prohibition of new accounts, and the disclosure of account holder information, sparking huge concerns over international jurisdictional overreach. Rumble and TMTG, empowered by US free speech protections, argue that such gag orders are fundamentally at odds with the First Amendment and violate US sovereignty. The legal action emphasizes that a Brazilian court cannot unilaterally dictate terms to an American business without United States government consent, a perspective that is central to their argument in the filed lawsuit. Pioneering the charge is Rumble's CEO, Chris Pavlovski, who has been vocally against Moraes' authoritative grip on online discourse. Drawing attention to the potentially global ramifications of this case, Pavlovski warned that allowing this type of foreign meddling sets a dangerous precedent for free speech worldwide. Shortly after Moraes' scrutiny ramped up earlier in 2023, Pavlovski notably cut off platform access in Brazil as an act of protest against such impositions on expression. Rumble's platform, bolstered by robust infrastructure cherished for being impervious to big tech cancellation, has recently reported impressive growth. The company snagged a whopping 67 million monthly active users in the third quarter of 2024, complemented by breaking into number 3 in the Apple App Store's photo and video category during a peak political moment on election night. Meanwhile, Trump's platform Truth Social, that relies on Rumble's back-end tech, is equally invested in standing up to these extraterritorial demands, seeking that US companies remain governed by domestic, not foreign laws. Stay tuned, as this bold legal push could not only define free speech parameters across national lines, but also inflate the robustness of American constitutional standards in our increasingly interconnected yet divisive world. What happens in this legal arena could very well shape the landscape of digital discourse moving forward. Arista Networks is creating quite a buzz today, though unfortunately not in a way that made their stockholders want to break out the confetti. The company's lower-than-expected annual guidance is casting a bit of a shadow over what was otherwise an encouraging Q4 performance. Let's dig into the nitty-gritty of what's cooking in the Arista Networks kitchen. First up, the techno wizards at Arista reported a 25% year-over-year growth in sales, totaling $1.93 billion. This was 1.5% above what those ever-optimistic analysts on the street had penciled down. The real superheroes here were the services, carrying the team to victory, while the product billings decided to step down a level and only come up by 20%. Still good, but analysts were left wanting more, a bit like ordering a large garlic bread and only getting 2 slices. Now here's the kicker. Nearly half of the full-year revenues were delivered by the CATs, aka Cloud and AI Titans. In plain English, these are the giant, shiny AI elephants in the virtual room, including big names like Oracle and Google. And while Arista Networks nailed yet another powerhouse quarter, by outshining across all sectors and maintaining their spectacular operating margins, they announced a potential shortfall with an updated annual revenue growth expectation of 17%. This number was a tad low compared to the rosy cat spyglasses prediction of 19.4%. Despite this dodgeball move on revenue guidance, the report was dropped like a mic against a backdrop of thrilling earnings season tempo. Analyst James Fish still gave Arista a nod by slightly upping the price target, but chose to keep his overall rating surface stable at neutral. His and other analyst concerns seem to revolve around slowing product billings and competitive pressures. Still, let's give credit where credit's due. The Cloud Titan segment had a handsome growth of 33% year-on-year, which is a tasty morsel considering that network spending is down globally as a fraction of total cloud capex. In fact, if industry whispers are to be believed, there might just be a stealthy coup operation underway with Google for AI backend systems. An AI-illuminating prospect indeed. Even though the quarter was solid, it wasn't enough to keep the stock price from taking a 6.05% nosedive to 104.41 cents at last count. In the end, it seems like Arista is a symphony in progress, with a few notes they need to fine-tune to hit the high notes with the stock market salon. If you're an investor, keep your eyes peeled. Arista Networks might still very well be the Tolstoy epic of cloud infrastructure stocks, pegged to make exciting chapters ahead. Hey tech enthusiasts, we've got some sizzling news about AppLovin and why it's catching Wall Street's eye today. If you're into adtech and AI, this segment is definitely for you. AppLovin, a company that crafts ad-centric software, is in the news thanks to its jaw-dropping 4,700% increase in stock value since January 2023. Yes, you heard that right, 4,700%. This astronomical rise has made analysts sit up, take notice, and even speculate that the company might soon follow the trend of splitting its stock. Stock splits, for those unfamiliar, can make shares more accessible to a broader audience by lowering the per-share price, like cutting up a pizza so everyone can get a slice. So, what's fueling this rocket-like ascent? Well, AppLovin's core business revolves around adtech software that leverages advanced machine learning. This software helps developers both market and monetize their mobile applications effectively. Their products, App Discovery and Max, use powerful algorithms to match advertisers with publishers. It's like a savvy matchmaker of the digital advertising world. Interestingly, AppLovin also owns a mobile game development studio, which earns money through in-app purchases and ads. However, in a bold move, the company plans to sell this part of its business for a cool $900 million. Talk about making it rain. This sale would let AppLovin hone in on its high-growth adtech software, especially its new focus area, e-commerce brands. Their recent financial results were nothing short of impressive. The company's fourth-quarter earnings report shattered expectations, seeing a 44% revenue shoot up to $1.4 billion. Their profit margin also widened by 25 percentage points, while their net income skyrocketed by a staggering 253%. While this rocket-fueled growth was primarily driven by their ad business, there was a bit of turbulence from a decline in sales from their app segment. Even more exciting, Wall Street analysts believe there's still more room to grow. They anticipate that AppLovin's earnings will grow at an average rate of 42% annually through to 2026. That's like strapping the company onto a financial rocket bound for the moon. Of course, with such rapid gains, the stock looks expensive at 110 times its current earnings. But if AppLovin can accelerate its moves in the e-commerce ad space, it could potentially outpace these lofty estimates. If you're feeling a little adventurous, this might be the stock to take a small gamble on. What do you think, folks? Are you ready to jump onto the AppLovin bandwagon, or do you see this as a dicey move? Leave your thoughts and comments below, and let's get the conversation rolling. All right, let's zero in on AppLovin. With its spectacular 4,700% rise since January 2023, this stock is the glittering centerpiece of the monologue today. But the big question is, would I buy, sell, or hold? Let's break it down. If you've been watching the adtech space, you'd know AppLovin has pulled off some major moves lately. Their software that helps developers monetize apps is driving their incredible ascent. We've also got their strategic plan to divest their game development studio, a smart maneuver giving them a solid $900 million to drill down on adtech, especially e-commerce brands. With their fourth-quarter earnings smashing expectations, we're seeing a 44% revenue increase and profit margins widening substantially. However, let's get real for a second. While the potential to grow this investment seems almost like rocket fuel, with experts eyeing a 42% annual growth rate through 2026, the stock's current valuation is no joke. It's trading at a pricey 110 times earnings. This means there's strong growth expectation built into the stock price. Any hiccup could spell a bumpy ride. So, would I personally jump in and buy right now? Considering the stock is soaring high, it feels a bit like looking into a dazzling fireworks show, thrilling but risky. I'd slap a hold recommendation on it for investors who already own it, given its strong growth trajectory. But I'd also exercise caution if you're thinking to buy anew, considering the high valuation and focus on analyzing their performance in the coming quarters. As always, don't just rely on a 5-minute blurb from me, your friendly tech news vlogger. Dive deeper into your research, study market conditions, and weigh this against your own financial strategies and risk appetite. Go look into their quarterly earnings reports, industry trends, and insider activities. After all, the best investment is informed investment. What do you folks think? Would you ride the AppLovin wave or paddle in safer shallows? Share your strategies below. In today's market shuffle, we've seen Rumble and the Trump Media and Technology Group dive headlong into legal waters, disputing international jurisdiction and censorship issues that could redefine digital free speech. Meanwhile, Arista Networks gave us a bittersweet ballad with a robust reporting dolorously overshadowed by cautious revenue guidance, a sure reminder of the volatile dance between expectation and performance. On the flip side, AppLovin metaphorically strapped on rocket engines with a whopping 4,700% stock increase, leaving us all wondering just how high this adtech comet can soar. If you enjoyed the tech tidbits today, Go ahead and smash that like button, share this video with fellow tech aficionados, and make sure to subscribe for your daily Tech Digest hit. Come back tomorrow as we explore a brand new tapestry of tech tales, from earth-shaking innovations to the quirkiest developments in the tech world. Let's keep this tech journey rolling.